In the year 2000, Netflix walked into a meeting with Blockbuster. They asked for $50 million, not to buy Blockbuster, to sell themselves. Blockbuster laughed them out of the room. At the time, the decision looked obvious. Blockbuster dominated the home video industry. Netflix was a struggling startup shipping DVDs through the mail. But that moment became one of the most expensive mistakes in business history, because within a decade, one of these companies would be worth billions. The other would disappear. So why did Netflix refuse to give up after being rejected? And why did Blockbuster fail to see the threat sitting right in front of them? In the year 2000, Blockbuster was the king of home entertainment. The entire experience was built around the physical store. The business was simple. If they were late, they paid a late fee. Those late fees were extremely profitable. In fact, they made up hundreds of millions of dollars in revenue each year. Netflix looked tiny in comparison. Founded just a few years earlier in 1997, Netflix did not have stores. It did not have scale. And it was losing money. Instead of physical locations, Netflix mailed DVDs to customers through the post. The idea sounded strange, slow, even impractical. Many people wondered why anyone would wait for a movie to arrive in the mail when they could simply drive to a store and pick one up instantly, which raised a serious question. Why would a company already struggling financially refuse to sell when the dominant player in the industry was sitting across the table? Blockbuster had built an empire around this model. Stores were everywhere, the brand was trusted, and the business generated billions of dollars in revenue. Netflix was trying to compete without any of those advantages. Instead of retail locations, they relied entirely on logistics. They needed warehouses, postal delivery, inventory systems, software, and the economics were fragile. Shipping physical DVDs across the country was expensive. Marketing to acquire customers was expensive. Technology infrastructure was expensive. In the early years, Netflix burned through cash. Then the dot-com crash hit. In the year 2000, hundreds of internet companies collapsed almost overnight. Investors stopped funding risky startups. Capital disappeared. Many startups shut down completely. Netflix suddenly looked vulnerable, and Reed Hastings knew it. Reed Hastings, Netflix co-founder and chief executive officer, made a bold move. He approached Blockbuster. The proposal was surprisingly simple. Blockbuster would buy Netflix for around $50 million. Then Netflix would run Blockbuster's online rental business. But there was a problem. Blockbuster did not think online rentals mattered. Executives believed customers enjoyed visiting stores. They believed the in-store experience was part of the appeal. Walking through aisles, reading the back of movie boxes, discovering something unexpected. And, more importantly, their business relied heavily on late fees. Netflix had removed them entirely. From Blockbuster's perspective, this model looked dangerous. It threatened the most profitable part of their business, and it came from a tiny startup losing money. So they passed. Inside Netflix, the situation was tense. The company was not thriving. Revenue was growing, but profitability remained distant. DVD logistics were complex. Customer acquisition costs were high. The dot-com crash made investors cautious. Selling to Blockbuster could have provided safety. It would have protected employees. It would have secured investors' returns. And it would have ended the constant pressure of survival. Some believed selling was the logical outcome. But when Blockbuster rejected the deal, Netflix faced an uncomfortable reality. There was no exit. The company had to survive on its own. The Netflix and Blockbuster story often gets simplified into a single mistake. Blockbuster laughed at Netflix, but the real lesson is deeper. Blockbuster did not fail because they rejected a $50 million acquisition. They failed because their business model trapped them. Late fees created enormous profits, but they also created dependency. Removing them would have weakened short-term revenue. Keeping them prevented innovation. In the year 2000, Netflix asked Blockbuster for $50 million. The request sounded desperate. Today it sounds almost absurd, but the meeting revealed something important. Blockbuster saw a struggling startup selling DVDs through the mail. Netflix saw the early version of a subscription entertainment platform. The decision looked risky at the time, but it revealed a simple truth about strategy. Sometimes the biggest advantage is not technology. It is the willingness to build a business around a future everyone else still doubts.